for the past 4 days, but guess what? We canceled our trip to Costa Rica to make sure we're back in time.
I know. We were going to stay later, but we missed you guys.
We got back late last night from our mastermind. So
yeah,
what'd you think?
Secret X.
It's a fun trip.
No, I think David Tupin, Kevin Easterly, Garrison Gilbert, and Maha, who was, let's be honest, was probably the one that coordinated a lot of this stuff. No, but it was a team effort. They did a great job. So shout out to them. We had an incredible time. Met some incredible people, and
it's all about the people.
No, it's a relationship business.
Business is a team sport.
It's a team sport. It's a relationship business, and then obviously the other half of it is obviously the numbers, data. That stuff doesn't lie, right? But it's all about getting back out there, folks. Yes, we had COVID. We're doing a lot of this virtual stuff, and we'll probably continue to do that. But events are starting to happen, so we're trying to get back out there. Prior to that, we went to Rod Cleese Mastermind.
Yeah, so busy 2 weeks.
Yeah, 2 masterminds in 2 weeks. We'll probably try to stay home for a little bit, hang out with the fam.
Thinking, find another one for next week. Let's keep the cadence going.
We'll see, man. We'll see. But anyway, Money Mondays, every Monday, come rain or shine, Costa Rica or not, we are with you guys at 3:30 p.m. Central Standard Time, dropping some fire, talking about being an entrepreneur, talking about investing, talking about real estate. So what are we talking about today?
Talking about the key metrics in commercial real estate and how to use them.
Ooh.
So those of you that hear a lot of jargon and phrases, we're here to kind of help decipher that and talk about the key ones and what to think about them.
Yeah, right? and I think it's important that and sometimes even on the show, folks, right, we're going to throw around terms and we just kind of gloss over it that everybody would know some of this stuff. Obviously, Google's a tremendous resource, the internet. There's plenty of this stuff that you can obviously look up. But, this is our way of trying to kind of provide a little bit of value and content to you. And, these are some of the metrics. These are not all of them. If you guys know some other ones that you want to talk, drop them in the comments. We love likes. We love shares. We love comments and questions. We want it to be interactive. If you guys do have some options in terms of, hey, this is what we'd like to talk about, right? Throw them in the comments. We'll try to roll it out over the next couple months. So, all right, first one's first. And these are not in any particular order. This is not probably the most important one, but we're going to go roll with it. Lost a lease.
Lost a lease. So I was actually we were literally just talking about that right before the show. There's a deal that we're looking at buying. The broker, basically sent us an updated rent roll. And on that deal,
what's a rent? Let's back up.
Rent roll is the table that lists all of the existing leases at the property.
Okay.
Right, but what we were talking about, and this is part of our business plan on many deals, right, is the lost to lease, meaning, hey, right now they're renting it at $1,300. Ben is currently a tenant. He's renting it at $1,200. There's a $100 lost to lease, arguably, right, as long as I can get it. So we were just talking about a deal where they're getting a lot of that lost to lease back, right? The renewals on their property, they're getting that $100 premium on the renewals, which is actually pretty good.
The flip side of that, right, when you're going to buy a deal, a lot of people will jack up their market rates, but they're not getting those rents, right? It's all smoke and mirrors. So you really want to study. That's why people look at the rent roll, folks. It's not just some table, oh, that looks interesting, right? You need to study it. You need to understand that there's some powerful data in there. And what we're trying to see is, what are the last 20 leases? How close were they to the actual market rent? And if they're within, 3 to 5%, or maybe they're even above that sometimes, right? You know that they're getting what they say that they're going to get, right? Versus every single lease is nowhere close. And we've seen deals like that where they've been $200 or $300 off. That you can't use that number in your underwriting because it's smoke and mirrors. So that's one of the reasons why loss to lease is it's a powerful thing to understand, right? So this is a fun one.
Yeah.
Debt service coverage ratio,
DSCR.
All right.
All right.
Me?
You want me to explain it? You want to go?
All right, you go with IRR. All right.
I'll do them all. I like numbers. So.
All right. So DSCR, right? You're gonna take your NOI, net operating income, divided by your total debt service. Debt service is your mortgage payment, right? So let's just use simplistic numbers, right? You've got $100,000 in NOI. You've got, let's just call it, $60,000 in debt service, right? You divide that by, the NOI. You come up with what, 1.6, 7, somewhere in that range. Somewhere in there, and that's
trying
what.
to make sure that you have some money left over.
Yeah, and then I was getting to the that's the calculation, which can be very simplistic, right? But why the lender cares about this, and this is really a lender-driven metric that operators need to understand. Why do they care about that, right? The higher that number, the more meat on the bone there is with that deal, right? Because you're even further covering the note. You have cushion there, right? Whereas if you're at 0.85 or you're below 1, you're in this distressed asset value add bridge deal, right? Whereas if you want to get a Fannie or Freddie deal, most of the times it's 1.25 to 1.3 minimum. They like to see a lot more than that. And typically, the higher that it is, the better loan you're probably going to get too, right? Because you can take on a little bit more debt because there's so much meat on that bone, right? And a lot of the sheets that are out in the market right now are going to calculate this, but you need to understand how this is. Once again, there's a ton of things online about this. So you get the fun one.
All right, IRR. This is the one that people either know it or they don't.
No.
And it's kind of complicated for most people. But essentially what it is it's talking about the return you can expect on an investment, right? Or really, it's a time-bound thing. So maybe the return that you got on an investment, right?
Yep.
Depending on if it's projected or not. And what it's trying to say is, what does that return give you if you account for the time velocity of money, right? So to keep it simple, if I had Ben invest in a deal, I gave Ben 20% for 5 years.
Okay.
His average is 20%, right? Now, he made 100% in 5 years. Now let's say instead I gave Ben 99% in year 1 and I gave him 1% in year 5, right? In that model, the IRR is actually higher than the other one, right?
Why
because
though?
you
Why?
had more money up front that you could then take and reinvest. Now, if I say, now let's again, a different deal. Let's say I gave him 1% year 1 and 99% year 5, right? That deal is actually a worse IRR than that first one and the second one, right? And so it's basically accounting for that fact of, compounding that money that you got earlier on.
The velocity of money, right, folks, right? You're going to get, and the good example there, you're getting 99% of the investment that you put in back, right? That you can then reinvest in other deals, right? So the IRR on that deal is better, right? So some people are IRR driven investors. I think it's one of a few things that you have to take a look at, right? Some people get so caught up in, if it's not a 17% IRR, then it's a bad deal, right? I think you have to take some other things into account, right? Risk, the market, the operators, right? And ultimately that needs to be baked in as well. But IRR is a very important metric that operators that are looking at deals need to understand, right? And your investors are probably going to ask questions about it. So get familiar with that term, right? The average annualized return, AAR, is a lot easier to calculate, right? In your first example, right, you said
20%.
You said it was 20, 20, 20, 20, 20, right? For a total return of 100. All you do is you take the total return, and total return is the sum of all the cash flows and all the net proceeds from the sale, and then you add that up. Let's call it 100 grand, right? And then you're going to divide that by the amount of years. Let's call it 5, right? There's 20% return, average annualized return that you're getting on that deal, right? So people need to understand that's kind of how that's calculated as well, right? And they're not lockstep with each other. Once again, IRR takes into account the time, right? Whereas AAR is a very simplistic mathematical equation, right? You take the total divided by the amount of years, and that's it. So that's another interesting one. I'm going to go ahead and pause there, see if there's any questions,
Money Mondays,
comments.
if anyone has any questions, basically, we do this every Monday through 30 Central. We do Q&A at the end of it. Right now, we're kind of going through our presentation phase, and in 5-10 minutes, start doing Q&A. So if you have comments, questions, please feel free to leave them, and we will answer.
If not, I'll keep drinking my coffee and keep rolling through this. What do we got? Anybody?
We got a few comments. Let's see. So Trevor says, your mind must hurt with all the masterminds. That's actually very true.
I love it, man.
You can hear it, our voice, lost a little bit of our voice as well. So
It was a lot worse yesterday, but
yeah, it's been a long 2 weeks.
I've since regained it,
So Jefferson says, how are you guys doing? Back to business. I know you came from Secret X. Yeah, that was a lot of fun.
No, it was definitely a lot of fun. Absolutely.
And Ray Costa says, hi, Trevor. Good to see you again. So
all right. Well, we appreciate you guys tuning in. This is some important stuff, folks. I'm glad that some folks are kind of listening in on this. And once again, if you have metrics that you track, whether it be on underwriting or on operations, we'd love to hear from you too, right? So let's go through 2 more. Cap rate. Why don't you roll on that one?
So cap rate basically means it's the Really, it's the percent return that a deal generates, ignoring everything else, meaning, everything else in terms of debt. So if I bought the property or that business cash, and all I did was I did the same thing as the current owner, meaning I didn't try to improve everything, I didn't try to improve rents or get
You just bought it
more
as
loss.
is.
I bought it as is and I ran it as is. That's the key thing.
Yep.
And how much percent can I expect to return on my money?
So
That's
all
what it
cash, no debt,
Now,
run it as is.
Yeah, and then there's gets to the point where people start talking about, okay, but now whenever I leverage debt, right, I can start to, I'm trading 2%, 3%, 4% debt on a business that's generating 8%. Well, now I'm actually increasing my margins, right?
Yep.
And so cap rate is really just a way to value properties or businesses really that could be very different because really you're looking at it purely on a profit basis.
And what do we do when we buy apartments, man? What are we doing? We're buying
Apartments.
businesses, man. No, I mean, folks need to understand, yes, it's real estate, but you're buying a business. And all of them are unique. They could even be in the same sub-market, right? They could even be some of the same vintage, same size. They're all run differently, right? They were constructed differently. Different people have owned them over the years, taken care of them, not taken care of them. So this is a way to kind of see where things are in the market with all this randomness, right? That comes up with these different businesses that we're going to own. Right? Generally, when it comes to cap rates, right, you're going to try to buy high and sell low, right? Because the higher your cap rate, the lower the purchase price, and vice versa, right? You're going to want to sell it on a lower cap because it's going to increase your purchase price. So it's kind of the inverse thing, and so people need to kind of look that up. Once again, tons of stuff about cap rates online, so check it out. All right, not just net operating income, the net operating income, right? Because it's very, very important, right? So this is how profitable is a business, right?
Yeah.
Now this not to be confused with distributable cash flow, right? But once again, you're trying to take some of the different metrics out of it and kind of how do you have a concise way to determine NOI, right? At the most high level, you're taking all of your income, call it total income, minus your total expenses equals your NOI, right? Now, this does not include your debt service or your mortgage payment. This does not include one-time CapEx things. And then we've seen other guys and gals that have thrown in all kinds of random stuff below the line. So when people say below the line, that means below NOI or net operating income. And that's really how you're going to value a property, right? You got NOI divided by cap rate determines the approximate value. Now there's obviously some things that can kind of play into that, right? Determining the market and everything else. But that's how much a property is potentially worth, right? And so NOI is pretty simplistic. Cap rates, you're going to get that from brokers, lenders, people that are really, really in tune with that market are going to understand where things are trading at in terms of cap rates, right? So that's how they kind of coincide in terms of how you use them. All right, so next slide, if I can make it happen.
I think the battery's dead. There we
Oh,
go.
there we go. All right, reversion cap rate. So talking about cap rates, right? You have a cap rate going in, right? Whoa, come back,
keep going. I
man.
was
Come here,
trying
you're
to-
killing me, man. You're killing me. All right, reversion cap rate. You have the cap rate going in, like I said, and then you have a reversion cap rate, which is what do you think cap rates are going to be in 3 to 5 years? And let me just get my crystal ball out. And ultimately nobody knows, right? But the rule of thumb, and people, there's all kinds of sides of this argument. What we tend to do is we beef up the cap rate. So if we buy it at a 5 cap, I'm going to say that we're going to sell it at a 5.5 to 6 cap, right? People say, well, how do you determine how much you beef it up? It's usually anywhere from 10 to 20 basis points per year that you hold the deal, right? Is the rule of thumb. Now, once again, not a hard and fast rule. I think it's dependent on the market. There's some places that are historically lower cap rates than, say, like a Texas, and you need to take that into consideration, right? That if you buy it at a 5 cap, it could very well be, you sell it in 3 years on a 4.25 cap, right? You just don't know, right? But it's better that can be your gravy, folks, right? Just go ahead and be conservative, and if the deal works then guess what? You're just gonna make that much more money on the back end when you go to sell it. So don't ever count that as, oh, that's gonna be part of my business plan, is that cap rates are gonna go down. If you do that, you're setting yourself up for failure, right? Because the net proceeds are supposed to be the icing on the cake, right? The real thing that people are always looking for,
It's cash on cash.
cash on cash, cash flow, baby. It's important.
Really look. That's if you kind of go back to, we talked about the NOI.
Yep.
Separate than the NOI, you have all your various expenses, right, below the line. You pay your every debt service, all these other
debt
things.
service, yep.
And cash on cash is really looking at based on how much money you put in and what annualized return are you getting.
Yep.
So it's really the number to me that matters the most, right? If I'm not betting on appreciation.
Yep.
Right. It's what am I generating? For putting in $1, am I getting back 10 cents, 20 cents? No sense, right? So
Yeah, and don't get me wrong, right? It's especially when you're starting off on these deals. There's a lot of capex. You're turning over the tenant profile. You've got COVID. There's things that happen, right? That it might be a little bit light on the cash flow, but you're trying to get that deal to a stabilized point where it is spitting off something, right? And typically, what people are seeing in the market, just to give you guys some perspective, is anywhere from probably 6 to 8. I've seen some deals push 9 to 10. Anything above that, I would question, right? Because, the way that asset prices have gone up over the last 6 to 12 months, it's putting a pinch on, how much money these apartments can actually make, right? So, I would question anybody that has double-digit cash-on-cash returns at this point, right? Unless they're buying in the hood. But the most important metric I think that we look at when we're looking at deals, right? Gross potential rent, right? I think this kind of coincides with, what we were talking about for loss to lease. So you have the gross potential, right, which is what do we think that we can get versus, what we call the net effective rent, which is essentially what's actually being got. So, and they're not necessarily always going to be the same, right? Because if there is an equilibrium at some point in the future, right, that means that you need to increase your gross potential rent.
And the gross also, the key thing too, it's assuming 100% occupancy.
Yes.
Right.
Yes.
Hence the gross part.
Yeah. So it's an important part of, once again, underwriting.
We weren't talking about Ben's jokes. 'Cause they're gross.
Equity multiple, right?
Yeah, it's one that I don't really like personally. Because it's not time bound. That's where IRR is the time. Not even that. I mean, average annual something, but like equity multiple. If I tell you a deal is a 3x equity multiple, the next question you're going to ask is it 3x over 2 years?
Yeah.
5 years, 10 years?
And we've seen some people that are going to be like, oh, you got 3x, and then they found out that they've owned the deal for 9 or 10 years, right? Still great for people that are patient with their capital, but if you want to constantly kind of be working your money, IRR might be a better metric for you to kind of understand. But it's another thing that people are going to see on investor decks. As an operator, as a syndicator, as somebody that's underwriting deals, you need to understand it. And why is it important? Because it's just going to be another thing that you're going to have to disclose and say, hey, this is what it is, right? And typically the higher, the more attractive it might be, once again, depending on how long the hold period is, right? We typically, just to give some perspective, it's 2x, within 5 to 7 years, is what it's going to be, right?
But this weekend, it was the 10x.
Oh,
mastermind.
Kevin. All right, so important ratios to analyze in your underwriting. I think that there's some other things, too, to take into consideration when you're looking at deals. What's your rent escalators? What's your expense escalators, right?
What that means is basically what is the annual increase for your rents and for your expenses, right?
Yeah.
They have a big impact on the underwriting.
They have a huge impact, right? And, as a lot of people saw, COVID really depressed rents for a good 12 months. Now we're starting to see a lot of things start popping, right? There's a lot of pent up demand in terms of rents because they haven't moved for about 12 months in a lot of areas. But typically what you're going to see is anywhere from 1 to 5%. Right, 5 being on the might be a little bit aggressive side, and then that's each year, right? So maybe you think that in year 1 I can do 5, but in year 2 it's going to be 2, right? Because you've already you've captured a lot of that room in the rents. Expenses too. Let's be honest, expenses are going up. Taxes, insurance, this stuff's not going down. Unfortunately, I mean we do everything that we possibly can to mitigate that risk. But you need to constantly be, expecting that expenses are also going to go up, and they might not be a 1-for-1, right? You might have no rent growth, and your expenses went up 5%. Does your deal still work, right? That's some of the modeling that you need to be doing as an underwriter, just to stress test your deal, right?
Absolutely.
And then last but not least, I think this is the last one.
I think it is too.
Expense ratios. right? And what is an expense ratio, man?
Expense ratio is basically just looking at, what percent of expense to income, right? So let's say for every $100 of revenue that I generate, I pay 60% of that, or $60 to my expenses, right? That's actual expenses, not debt service, right?
Yep.
That's your taxes, your insurance, but your payroll and your repairs and your maintenance. And so, typically most of those we're looking at anywhere from 45 to 65%,
Yep.
right? It's kind of it's very deal specific, area specific. But you're trying to just get a sense of how much of the money that's being generated is going towards those expenses. So,
and typically, this is not always the case, but most of the time, your older properties are going to have a higher expense ratio, right? And your newer ones are going to have a lower one. Why is that? Because there's just going to be less deferred maintenance, less maintenance in general. But sometimes on the newer deals, it's offset by your increase in taxes, right? So, typically middle of the road is 50%, but we've seen it as high as 65, and we've seen it actually on a few deals, 40, and on the newer Class A stuff. So once again, another metric as you're underwriting deals that you should pay attention to, right? And it doesn't necessarily mean that if it's a higher that it's worse, right? But maybe if you start looking at it, there might be some ways that it gives you some pulse, right? Where you can maybe potentially fine tune some expenses, and maybe you get in there and say, hey, it is what it is. I mean, we had a deal in Beaumont. It had chillers, it had boilers. There was stuff that made the expenses higher, and there wasn't going to be anything that we could do to get rid of them. No. So it was always going to be that high. Right? And so you just got to make sure that your deal still works. So I blew through that as quickly as I could.
Yeah, so let's see. So if you have any comments, questions, please leave them. We do Money Mondays every Monday, 3:30 Central. Ray Acosta says, before that, Trevor said, excited to join your conference in Miami. Got my VIP ticket.
All right.
Trevor.
Thank you.
Thank you. I look forward to seeing you there. Next up, Ray Acosta. So if cash on cash is the most important, what is the range you look for when analyzing your deals? Most important to your partners or your company?
Well, I think, and I mentioned some numbers earlier. I think realistically, you're looking in the 6 to 8% range right now, right? Once again, we were seeing some deals push to 9 to 10, right? But I would question anything that's above 10%, right? I would say that they might be being a tad bit aggressive, or there might be something off with their underwriting, right? Doesn't mean that's not possible. There's always that diamond in the rough, but folks, we have underwritten hundreds of deals already this year, and nothing is penciling out that high. Yeah. So just take that into consideration. That's kind of where the market is right now. So,
so let's see.
Any other questions?
Any other comments, questions? We will.
And I want you guys to dump. If you hear of some, you know of some, do we forget some? Dump them in the comments. This is for everybody's benefit. This is just some ones that we kind of came up with, that we take a look at. There's a ton of other ones, especially on the operations asset management side, that we could go into. This was more probably on the underwriting portion of things to kind of take a look at, but we can also do another asset management one too.
Absolutely. So let's see. So Iggy says, what's up? Welcome back.
What's up?
Thank you. Porterwood's looking really good, by the way, so far, so we'll see.
All right.
Let's see. Any other comments, questions? Abel Pacheco, thanks, gentlemen. You're very welcome.
Abel, thanks for tuning in, man.
Yeah.
I really appreciate it. Abel probably knows a little bit of, you underwrite some deals.
He knows
Come
a lot
on,
of
man.
These terms, probably all these terms.
Throw some of that stuff in there too. But folks. So what else we got going on? I know that they kind of dropped the hint about our MFIN conference. We want to go ahead
and keep going. So
let's get there.
What do we have coming up, Ben? Finally locked it in last Thursday.
I'm excited about this one too, man.
Multifamily Investor Network Conference. We do 3 of these a year. We're doing the next one in Miami. So we had our big one this past February.
Yep.
Home run, 150 people on the waiting list. And we're moving to Miami. So different crowd, different people, same awesome audience, same awesome content. So
we're going to get some great speakers, that we're going to be announcing over the next couple of weeks. Some great panels. And ultimately we try to curate the whole entire day so you get some opportunities to network throughout the day, right? This is what it's about. It's learning. You're going to get some golden nuggets, but you're not going to learn the whole business in one day. It's all about developing those relationships and continuing to learn in this business.
And we do it really, we don't make any money on it. It's
No.
really a chance to kind of put that environment together, and we just love talking and networking with people. So,
And who doesn't want to go to Miami? Come on.
yeah,
You
and
know,
it
that's
is the
beach.
lowest price it'll be. So
This
prices
is the
do go up.
early bird, right?
Yeah, so use the coupon code EARLYBIRD and you'll get $150 off. So
not bad. So what's the address?
www.mfinvestornetwork.com.
All right, put early bird in there, coupon code. And Shanna, when's this expire?
May 7th.
So this expires May 7th. So this is the earliest, best pricing that you're going to get. We literally just announced it this morning. So check it out. Get your tickets in before May 7th, and you'll get that $150 off. We're excited to see everybody. Going back real quick here. Let's go back to the toolkit. There's not going to be a week that we don't talk about it because it's awesome, and Shanna does a great job with it. So check that out, www.disruptequity.com/toolkit. And it's got all of our checklists. It's got all of our webinars. It's got all of our podcasts. It's got everything on there. It's completely free. So check it out. We love for you guys to give us some feedback on this stuff too. But moving right along, what are we talking about next week?
Talking about basically, what it takes to go from LOI to closing your property. So what are all the steps that happen in between there? It's hectic. There's a lot that goes on, and it's important to understand what those are and make sure you're aware of them and how to complete them.
All right, strap in, because that's going to be Ben speed talking through that whole entire thing in 30 minutes.
Yeah, and we all know how much Ben hates talking.
No, I hate it. But no, this is an important topic. So everybody tune in, and we'll try to go through it as quickly as I can. It might be a two-parter. I don't know.
And we got about a minute and a half, so if anyone has any comments, questions, please go ahead and leave them. We will answer them. Abel says, thanks, gentlemen. Always great to get refreshers and additional knowledge.
No, appreciate it, buddy. Appreciate it.
Right.
So yeah, hopefully we had some value today.
Or we're going to call it a day, and Ben and Ferris can go rest. We should order like a massage to the office, from this
I'm
Costa
feeling
Rica
great,
trip.
man.
Yeah,
This
you're feeling
coffee
great.
is awesome.
No, actually, the very first day, the very first night of the event, they did a team exercise that morning. This guy didn't show up, for the record, but what I like to joke about it is the person that led it was a professional basketball player.
Hey.
And I'm like, why do we have the professional basketball player lead the thing?
And you were complaining about how much you hurt the whole
Oh,
entire rest of the year.
No, what's amazing about it was only like 15, 20-minute exercise too.
All right.
So I'm actually
all
pretty
right.
impressed I got that sort
We'll
of
let him.
minutes.
We'll let him sleep a little bit tonight. All right. But no, check us out next week, 3:30 p.m. Central Standard.
Yes,
Thank
sir.
you.